Bill, welcome to the show.
Thank you. It's good to be here, Craig.
So what do people need to know? We're getting to the end of the year. I don't know if that's too relevant to 1031, but let's start with explaining what it is. I mean, so people have a better understanding.
Well, the 1031 exchange really allows an investor to sell a rental property, property held for investment, and defer the payment of their taxes into a new property, so by buying a replacement property. So rather than selling a rental property, having to pay a third of their capital gain in taxes, this allows you to keep all of the income in your pocket, working for you, so you can trade up and buy a bigger property.
I know a lot of people are paying attention to those capital gains. I think that's kind of a moving bullseye. We don't know if they're going to go up. So this allows you to really build wealth. I know we have a slide for you that you're going to break down for us on just how this can be leveraged to build wealth and also reduce those taxes. What are we looking at, Bill?
You know, a lot of people look at the 1031 exchange as a transactional tool to defer taxes, and it's really a wealth building tool. So if you were to just sell and cash out and pay the tax, you lose a third of your gain to the government. So with the 1031 exchange, over a long period of time, you keep deferring your taxes, you can build your wealth much, much faster. So this slide just shows you kind of a comparison between those who sell, pay the tax, versus those investors who are more sophisticated, who sell 1031 exchange, defer the taxes into a new investment property.
Well, Bill, there's some rules around these. I know there's time frames. You're selling one investment property, you want to reposition it into another property, not pay that capital gains tax. How do the rules along all this work?
Good question. You know, they have to have qualified use property. That means the property they're selling and buying has to be held for investment or rental or used in a business. They have to sell, identify what they're going to reinvest in within 45 days,
okay,
and they have to complete that purchase within a total of 180 days.
And what do they have to buy? What are the rules on what they have to buy?
Actually, when you're talking about real estate, the definition of like-kind property is very broad. So as long as the property is rental, investment, or used in a business, any kind of real estate is like-kind. So it's a great way to either diversify or consolidate your portfolio depending on what your goals and objectives are.
And it has to be bigger and better. So if you sold a duplex or a fourplex and you've built some equity, it's cash flowing, and now you think there's that opportunity to buy an apartment building, I mean, would that work here?
Absolutely. In fact, that's probably a perfect example where they have a single family or a duplex and they're ready to trade up into an apartment complex of 8 or 10 units or more. And if you had to pay your taxes, it would be very difficult to do that. With a 1031, they could easily do that because they have all their cash to reinvest in the larger property.
So what are we looking at here, Bill? Break this down for us.
This is a quick summary of the different types of taxes you're going to be looking at if you don't 1031 exchange. So if you decide to sell and just cash out, everyone's familiar with the federal capital gain tax, and historically it's been a flat rate of 15% for most taxpayers. With the changes that came about January 1st of this year, it could be as high as 20% now, depending on your adjusted gross income. Then, of course, we have that little hidden tax that came out with the Obamacare tax.
There's no of course here, Bill. That's the thing. No, there's no of course, because people don't recognize how much your income is being pillaged by some of the increases we're seeing in taxes.
That is true.
So much that Governor Rick Perry out of Texas runs commercials in our state encouraging businesses to move to the state of Texas. It's bad. Now this 3.8%, nobody talks about this in the media. Explain that.
Sure. And it was a little provision that was hidden inside of the Obamacare plan. So it was snuck in there, and not really that many people saw
snuck in
that
a few
until
thousand
after
pages.
December 31st.
Yeah, there's a lot of things snuck in there.
Just snuck in there. So what happens is if your adjusted gross income is over $200,000 if you're single, or over $250,000 if you're married, you get an automatic 3.8% tax on any passive income over $250,000. So the sale of property is a capital gain right off the bat. That typically puts you in that category.
What are some of the other taxes associated with all this that the 1031 helps to protect you from?
You're also going to have depreciation recapture tax, probably. You know, if you own an apartment complex for 10 years, every year you depreciate that. You write off a percentage of that on your tax return. If you sell and cash out, all of that depreciation is added back to your income tax and taxed. If you do a 1031 exchange, all of that depreciation is deferred into the new property. So most investors forget about the depreciation recapture, but that's a big one. And then you have your state tax. So here in California, you have up to 13.3% capital gain tax. And actually, they don't have a capital gain tax. It's just ordinary income tax. So it just depends on what adjusted gross income category you fall
Bill,
into.
is it fair to say that we want you to pay your taxes? However, make sure you make the right strategic decisions. I mean, you lose so much money, and if you leverage a 1031 exchange, it's not cheating the system, it's leveraging the law. 1031 is actually a tax code, if I understand correctly. Is that right?
That's absolutely right. So they want you to pay your fair share, but the 1031 is a section 1031 of the tax code, and it's a legitimate way to defer your taxes. It's not tax-free, it's tax-deferred, so you're deferring it into the future. Unless, of course, you keep exchanging throughout your lifetime. When you pass on, your heirs will receive a step-up in cost basis. That literally means that your capital gain taxes and your depreciation recapture taxes completely go away at death.
Well, I just want to make sure, Bill, that nobody goes and sells their home end of this year, going into next year, and then takes that gain, and then at the end of the year gets hit for the capital gains tax and says, okay, well, let's go buy another investment property, when they could have slid this thing over, bought a bigger and better property, gone through the 1031 route, not had to pay that liability, and still accomplish the same goal. Your information is great. I hope people that have investment properties, whether they're selling now or in the future, you reach out to Bill Exeter. The website is exeter1031.com. You see it on your screen here. Bill, great information, very unique information. I know a lot of people can take advantage of, and I appreciate you coming into the American Dream here today.
Thank you. My pleasure.